Okay, so you want to own a real estate investing business. You've watched viral videos on the internet. You've watched the guys in crisp polo shirts standing in front of freshly painted modern farmhouse flips holding a Starbucks cup, talking effortlessly about passive income and cash flow. You picture yourself waking up at 9 a.m., opening your banking app, and watching rent checks cascade into your account while you plan your next vacation to Cabo. You are the landlord, the mogul, the architect of generational wealth, escaping the rat race. Look at this, everyone says. Buy dirt. They aren't making any more of it. Here is the problem. The truth is, real estate investing isn't really a passive income business. It's a ruthless debt management and contractor babysitting operation randomly dressed up as a path to financial freedom. Sit down, put the Rich Dad Poor Dad book away for a second. We are going to rip apart a real profit and loss statement. Not the Excel template your favorite guru sold you for $997. I'm talking about the actual math, because math doesn't care about your vision board. Let's see where the blood is actually leaking. Let's look at the standard single-family rental, SFR, the absolute holy grail of the middle-class investing dream. You find a deal for $300,000. You drop 20% down, that's $60,000. You think you're in for 60 grand. You think that's your skin in the game? Wrong. Closing costs, loan origination fees, appraisal, inspection, title insurance, and a fresh coat of paint. Bang. Another $12,000 evaporates before you even get the keys. You are in for $72,000. Now, you need to rent it out. Market rate is $2,500 a month. That is $30,000 a year. On paper, the paper amateur investors use to justify bad decisions. You divide $30,000 by your $72,000 cash invested and think, wow, over a 40% cash-on-cash return. I have actually watched grown adults do this math, conveniently forgetting that a commercial bank expects to be paid back. Let's run the real numbers. Your mortgage at current 7.5% interest rates on a $240,000 loan is roughly $1,678 a month in principal and interest. So $2,500 minus $1,678 leaves you $822 a month, right? 10 grand a year in pure, unadulterated passive joy? No. Property taxes, let's say $4,200 a year. Insurance. It used to be $900. But surprise, hurricanes, wildfires, and inflation happened. Now, it's $2,100 a year, and your carrier might just drop you next April because a Google Earth satellite saw a tree branch hanging too close to your roof. We are now down to $3,564 a year, or $297 a month. But wait, you have a day job. You can't unclog a toilet at 2 p.m. on a Tuesday. Enter the property management PM company. They sell you peace of mind. They charge 10% of gross rent. That's $250 a month. You are now at $47 a month in profit. $47. You can't even buy a decent steak dinner with your financial freedom. And we haven't even touched the silent killers, the hidden costs that the seminar speakers casually wave away as the cost of doing business. Let's look at the actual reality of property management. You think paying that 10% fee means you are completely hands-off? They don't just take 10%. They make their money on friction. When a tenant moves out, the PM charges you a leasing fee, usually equivalent to one full month's rent, $2,500, just to put a warm body back in the house. When the tenant renews a year later, a $250 lease renewal fee. And maintenance? This is where the bleed gets systemic. When a tenant calls about a leaking pipe, the PM dispatches their preferred vendor. The plumber charges $200. The PM slaps a 10% to 20% oversight surcharge on the invoice. You get billed $240 for a flapper valve. Your wallet is being drained by 1,000 administrative paper cuts. Then comes vacancy. You will have empty months. You have to paint, clean carpets, and market the unit. A standard 5% vacancy rate mathematically wipes out $1,500 a year. Then comes CapEx, capital expenditures. This is the absolute widowmaker for amateur investors. A roof lasts 20 years. An HVAC system lasts 15. A water heater lasts 10. These aren't theoretical what-ifs. These are physical, depreciating assets hurtling toward their inevitable mechanical deaths. You need to hold back at least $250 a month just so you don't go personally insolvent when the HVAC compressor blows up in the middle of a July heat wave. Let's tally it up. Rent, plus $2,500 P&I, negative $1,678. Taxes and insurance, negative $525. Property management, negative $250. Vacancy reserve, 5%. Negative $125. Maintenance reserve, 5%. Negative $125. CapEx reserve, 10%. Negative $250. Your true monthly cash flow, negative $453. Congratulations. You just paid $72,000 for the immense privilege of losing $453 every single month. You are essentially subsidizing a stranger's housing with your W-2 income. You say, visibly sweating now. I won't buy single-family homes. I'll buy commercial multifamily. I'll play the big game. It's all based on cap rates. You log onto a commercial real estate loop, find a 10-unit apartment building, and look at the broker's pro forma, a fancy Latin word for completely made-up numbers. They hit you with the magic industry metric, the cap rate. They make it sound like an absolute law of physics. The math is supposed to be simple. You just take the net operating income, the NOI, and divide it by the asking price. That is it. That is the whole equation. So, the broker tells you the building generates an NOI of $100,000 a year. At an 8% cap rate, the building is priced at $1.25 million. You think it's a steal. Here is what the broker is hiding in that calculation. Sellers manipulate NOI by deferring maintenance. The seller managed the property himself, so he zeroed out the management fee on the spreadsheet. He patched the leaking roof with $50 worth of tar instead of replacing it, so his repair costs look magically low. And the property taxes? They are based on an assessment from 2017. The minute you close, the county will reassess the property at your $1.25 million purchase price, and your tax bill will instantly double. Your actual NOI isn't $100,000, it's $65,000. You just overpaid for a decaying brick box, and your debt service on $1 million commercial loan is going to choke your cash flow to death. Commercial loans aren't 30-year fixed mortgages. They are 5-year or 10-year terms with balloon payments and adjustable rates. When the term is up, you have to refinance. If interest rates have spiked, your property values plummet, you can't refinance, and the bank takes the keys. Fine, you pivot, sipping your now cold latte. I won't be a landlord. I'll flip houses. Force the appreciation. The BRRRR method. Buy, rehab, rent, refinance, repeat. End quote. Oh, beautiful. You want to play in the dirt. Let's talk about the brutal economics of renovation. You buy a distressed property. You can't use a normal bank because traditional lenders don't finance houses missing copper plumbing and half a roof. You use a hard money lender. Hard money is not friendly. It is predatory liquidity. They will charge you 12% to 14% interest, plus 2 to 3 percentage points of the total loan amount just to close. You borrow $200,000. You pay $4,000 on day one, just for the privilege of accessing the cash. You now owe $2,000 every single month in interest. Only interest. Not a single cent goes toward principal paydown. You budget $50,000 for the rehab and 8 weeks for the timeline. Here is the psychological warfare of dealing with contractors. The genuinely good ones are booked out for 8 months and charge a premium. The cheap ones? They will steal your materials, ghost you on a Friday after taking a draw payment, and leave your house exposed to the elements. Your $50,000 rehab quickly becomes $75,000 because you opened a kitchen wall and found black mold, asbestos floor tiles, and knob and tube wiring from 1,942 that the city inspector demands you bring up to code. Your 8-week timeline balloons into 5 months. The city permit office went on a holiday break, and then the inspector denied your framing permit because your cheap contractor cut through a load-bearing joist. Every single month you wait, that $2,000 hard money interest payment bleeds you. Property taxes bleed you. Utility bills to keep the lights on for a vacant, uninsulated house in December bleed you. Builder's risk insurance bleeds you. By the time the house is finally ready to list, the macroeconomic market has shifted. The Federal Reserve ticked rates up by 50 basis points. Buyer demand dried up. The house sits on the market for 60 days. You drop the price. When you finally sell, you pay 6% to real estate agents, 2% in buyer concessions to buy down their mortgage rate, and another 1% in closing costs. You spent 9 months having rolling panic attacks, ruined your credit utilization, argued with unhinged subcontractors. and walked away with $4,100 in net profit before short-term capital gains taxes. You would have literally made a higher hourly wage flipping burgers at a fast food joint. Eventually, the gurus will tell you to scale. You just need more doors. Use other people's money, OPM. You start a syndication. You become the general partner, GP, and raise capital from limited partners, LPs, doctors, dentists, and tech workers who want passive returns. You think scaling makes it easier. It actually makes the business exponentially heavier. Real estate is an intensely hyper-local, operationally dense logistics business. You are essentially managing a crumbling infrastructure network scattered across different zip codes. You are no longer just herding plumbers. You are herding investors who email you at 11 p.m. on a Sunday asking why their quarterly distribution was short by $50. You are paying massive CPA fees to generate K-1 tax forms for 30 different people who all think they know how to run your business better than you do. You are managing tenants who lie on applications. Tenants who sneak in unauthorized pit bulls that chew through door frames and destroy baseboards. Tenants who suddenly stop paying rent and know exactly how to weaponize the local eviction courts to stay in your unit for 7 months rent-free while you are still legally obligated to pay the water bill and the mortgage. And the legal liabilities scale with you. Slip and fall lawsuits on an icy sidewalk, black mold respiratory claims, a roofer falling off your property without his own workers' comp insurance, meaning his lawyer is coming after your LLC. This is not a passive investment. S&P 500 index funds are passive. You buy the stock, you close the app, and you go play golf. When you buy a piece of real estate, you are buying a second, highly demanding job. You are buying a highly illiquid, physically decaying asset that requires constant, aggressive capital injections just to maintain its current baseline value. Look at the lifetime revenue chart of a real estate investor. It is never a smooth, predictable upward curve. It is a jagged, terrifying heart monitor. You will see 12 months of tiny, incremental gains completely wiped out in a single afternoon by a $15,000 sewer line collapse. You make a slow, agonizing crawl back to your baseline cash position, only to get hit by an eviction that costs you $9,000 in lost rent, legal fees, and unit turnover repairs. This entire game is built on leverage, and leverage is a chainsaw. It is a fantastic tool to cut down a tree quickly, but if you hit a knot in the wood and it kicks back, it will cut off your leg. When asset prices go up and money is cheap, every idiot with a mortgage looks like a financial genius. When values flatten out, rent growth stalls, and your holding costs stay high, the debt eats you alive, from the inside out. So, if you want to step into this arena, strip away the delusion right now. Stop looking at subway tile backsplashes, brass cabinet pulls, and drone footage of apartment complexes. In this business, the winner isn't the one who makes the prettiest product. The winner isn't the one with the most aggressive Instagram marketing. The winner isn't even the one with the best eye for neighborhood gentrification. The winner is the one who controls the cost of capital. If you can borrow money cheaper than the other guy and ruthlessly manage your operational bleed down to the penny, you might just survive. If you can't, you are doing nothing more than providing temporary liquidity for the institutional predators who will buy your foreclosed dream from the bank for pennies on the dollar. Math doesn't care about your feelings. Welcome to real estate. Bring a helmet.